Gentlemen, how goes it? Dylan, your new spot looks great, man. How are you enjoying the new digs?
And how am I enjoying the new spot? Um, it's great. Moved in this summer, so just another lease. Not buying any real estate. It's a shit coin. But yeah, we're excited to chat here for the next hour or so.
Yeah, I mean, we're sorry to cut you off, Sam.
No, cut me off. I was just going to say, hey, what's going on? Good to be here.
So I am running under the assumption, and I'm assuming we're all on the same page, but this Contagion report that you guys put out yesterday was truly phenomenal. The time you took to break down not just the Luna nonsense and debacle yet again, but also kind of really explain the Gbtc arbitrage we've been seeing in the marketplace, as well as a couple other areas that have been, I think, capitalized, taken advantage of. Unless there was a specific one you guys wanted to start with, I'd love for you guys to just maybe touch on the overviews before we dive into these individually.
Yeah, I guess I can start. So the report was a lot of kind of not reflecting, but going back and covering a lot of the stuff that we have written about a bunch before, and just really kind of summarizing it in one place. There wasn't too much kind of groundbreaking analysis or what's it called, like predictions for the next house of cards to tumble or the next company to collapse. It wasn't so much that, and there was some assumptions kind of baked in there, but it really was just a broad review of how we got here, the reason that Bitcoin is trading at 20K, the reason why we've seen this huge kind of unwind occur in actually a pretty spectacular fashion, and what led to it. What led to Celsius closing their doors, halting customer withdrawals and deposits, withdrawals and trades. Why BlockFi is needing a bailout, why Voyager is needing a bailout, how Three Arrows Capital blew themselves up in more or less a fraudulent way. So the report was essentially just kind of detailing some of the events that got us here, from spanning back to all the way to the 2020 start of the bull market. And so I don't know if you want us to dive into anything in particular in terms of like the trades or the ARBs or whatnot, but I guess the summary, just to hop to the end real quick, that the conclusion of it is Bitcoin denominated yield isn't actually yield, and the kind of reason we're in this sort of crisis, aside from the macro environment, aside from the dollar appreciating its risk, is that you had a whole bunch of people and a whole bunch of companies treating yield or offering yield products when it was always an unsustainable idea. And so we're kind of feeling the repercussions of that today.
Sam, I'll let you comment, and then I will say I would love to dive into just each of these individually if you'll entertain me.
No, I would only add, I mean, Dylan said it well. This is just kind of an overview of a lot of market dynamics that started back in this kind of 2021 bull market. And we can get into kind of some of the GBTC trades, the arbitrage, the yield, and how quickly all of that, pretty much collapsed, along with, we don't get into really much of the macro picture here, but you have, this turning tides, liquidity, macro, global picture unfolding, while all of this in like the space, Bitcoin, crypto specifically, it just amplifies everything. So it's just really kind of cascading waterfall effect, and a lot of it unwound pretty fast. And in the end of the report too, and we're releasing this to everyone on Friday. Just had released it to paid subscribers yesterday. Also just offering like a full timeline of all of these events and all of these companies that are playing out, so we can get into some of that as well.
Let's kick it off with the GBTC arbitrage, because GBTC is in the news a lot right now to try and become a spot ETF, but I don't think a lot of people really understand what their offering is. Can you guys break this down? You've done an excellent job before we dive into the arbitrage opportunity there. Like, what exactly is GBTC?
Yeah, so apologies for anyone that's familiar with the arbitrage or the product, but I guess just a brief overview. We wanted to make the report very normie friendly, for lack of a better term, just able to be digestible, able to be digested just by the average kind of market participant or someone that's not in the weeds, kind of understanding the ins and outs of all this. So Grayscale Bitcoin Trust, it's been around since I believe 2015, was the first kind of Bitcoin exposure that was available in public markets. And basically you can go bring $100 to, or obviously any amount, but of dollars or Bitcoin to Grayscale, and they'll give you shares of GBTC, an equal amount of Bitcoin or value, and those trade over the counter. The only catch was, or is rather, that those shares are locked for it was previously a year, and then before 2020 got amended to 6 months. So and unlike ETF, they don't trade at exactly par value. So for the longest time, and we have the visuals in the report, for the longest time those shares traded with a super large premium. So what you could do is you could, and especially this exploded in popularity in 2020, you could bring Grayscale money, say it's trading at a 20% premium. You give them $100, you get $120 of GBTC market value, and it's locked for 6 months. And so, kind of in the 2020 bull market, Grayscale already owned, I think, around 250,000 Bitcoin at the start of 2020. And Bitcoin's obviously much smaller in size and liquidity, but there was a premium there. And post kind of COVID 2020 financial market meltdown, the Bitcoin narrative caught on really strong. That premium was still there. And essentially a ton of people, a ton of funds really piled into this trade where they'd bring, even if they had no Bitcoin interest, they'd bring Grayscale dollars, bring Grayscale Bitcoin. It would turn into shares of GBTC. And what you could do, there's two different kind of trades you do, or maybe three, I guess. You could bring your money to Grayscale, you get GBTC, and you could short some Bitcoin exposure. So if you had access to CME futures or Bitcoin derivatives exchange, and a lot of the TradFi funds don't have access to the native Bitcoin exchanges, derivatives exchanges, but say you could short CME futures Bitcoin. But well, then you're capturing with a delta neutral strategy, you're capturing the premium as a yield. Right? So if it's a 20% premium, you short Bitcoin futures and you are long GBTC, then you stand to capture that spread at the end of 6 months. What you could also do is buy the premium, you wait for the 6 months. At the end of it, you sell your GPT, you buy Bitcoin, and whatever that premium was at the time you sold it, and you buy Bitcoin, and let's just forget about taxes for the moment, you would capture a Bitcoin native yield. So you have exposure to Bitcoin the entire time, but as long as there's a premium at the time you sell it, at the end of the 6 months, then you can capture a basic alpha on top of Bitcoin. And then some funds, just because they didn't hedge whatsoever, and these guys, ironically, the ones that were quote unquote irresponsible and didn't hedge for that 6 month time lock, as GBTC turned in, the premium turned into a discount in around February. It was really just like a lot of funds at the end of 2020 wanted to mark up their books. So they brought money to Grayscale, immediately marked up their books at 20-25% premium, and it looked good for like year-end reports and whatnot. And even though the premium turned into discount in February, 6 months later, Bitcoin's still in the 40,000s, and they sold for a pretty big gain. And so right now, obviously that GBTC premium is not premium, and is its deep discount at around 30%. And given how much Bitcoin actually Grayscale holds, we think that there's quite a significant market impact on spot Bitcoin, because you essentially have 650,000 Bitcoin, a derivative or a trust or a product out there on the market, able to be purchased for around equivalent to say $14,000 Bitcoin. And so that's a pretty big overhang at the moment, and it's kind of like the reverse of 2020, where Grayscale purchased 4,000 Bitcoin and it kind of supercharged the bull market. Now we see the hangover effect of all this, where there's this product that's not as liquid, not as portable, and obviously not censorship resistant. That's kind of weighing on the exchange rate of Bitcoin as it's this incentive for any institution that wants exposure. They're not going to go buy Bitcoin. They're just going to buy GBTC, for equivalent price of $14,000 Bitcoin. And so Obviously, an ETF would change this, but I have no confidence, or actually, I'm not confidence, but I have no hope rather that Gary Gensler and the SEC is going to approve of a spot ETF, especially after the last month or so of craziness in the crypto industry.
We're going to speculate a little bit. Okay, cool. Sorry, I thought I was hearing an echo. I want to speculate a little bit. You brought up, the window dressing that you see at the end of the year. It's been a really rocky month, but tomorrow the quarter's over. How much do you attribute, the overall market sentiment to being, just a window dressing attempt at the end of the quarter versus, oh shit, everything is actually falling apart because it's all built on lies?
Can you repeat the question? Or maybe Sam, you want to hop in? I didn't really catch the end of it.
How much?
Yeah,
Oh, go ahead, Sam.
No, I guess here's like kind of your question is like, what if we're just like speculating here, like hypothesizing what of like the latest price action is more like window dressing, or like that it's mostly downside to come. Maybe if you want to rephrase, that could help.
Yeah, I mean, I think you said it better than I even asked it, but essentially that there's a lot of downward pressure, it seems like, coming from all aspects of the market. I am keeping an eye on the calendar, and I see it's not a coincidence. You see this at the end of quarters consistently across industries. And I'm just curious if there may just be this added pressure. And I say added not to negate, the unwinding we're witnessing of the likes of Three Arrows, Celsius, and so on, but rather an additional downward pressure that's led us to feel this gap widen, um, caused by window dressing, caused by a downward selling pressure to end the quarter, making a portfolio look the way it needs to look.
Yeah, totally. Gotcha. Yeah, I mean, it's a good question. In terms of like the mix, it's probably pretty hard to quantify unless like you're really deep into like rebalancing like portfolio flows, saying measuring what level of impact that is. And I've seen some of that like on the equity side, but maybe not so much on Bitcoin. And think, that was a big narrative of the end of the year too, into December, of like, why are we getting this extra kind of downside pressure that looks like more of a beta move that is separate from equities, and a lot of that being positioning and rebalancing and potentially tax harvesting around that time too. So it's certainly happening and going on. Hard to say to like what extent, but I guess I would say like how I think of it. I mean, even if it has kind of an impact or is amplified in some ways, that there's just more, whether it's the forced liquidation moves and we just saw from kind of all of this contagion blow up happening right now, or still kind of like positioning to not necessarily quarter end positioning to sell, but positioning through the rest of the year for risk assets to change too, kind of on a higher level, or just like this general connection that Bitcoin moves in these economic cycles that it can't really avoid. So like when we have, big booms and busts and contractions and recessions, and put out a piece last week of looking at that versus like the PMI as one economic indicator, those forces are just kind of much larger. So I don't think, unless maybe, it's kind of like a significant end of the year move or the narrative seems really strong, you can start seeing that a lot of people like push that out in data, that I don't put too much weight maybe into the rebalancing or kind of impact that has, kind of short term.
I'm just simply going to point out, for everyone who is listening over on Twitter Spaces, feel free to pop on over to YouTube where you can see all of our pretty faces. Dr. Jeff Ross, thank you for watching, pointing out that the huge volume last Friday, just in the equity markets broadly, was related to most likely related to quarterly rebalancing. So while it's happening in the equity markets, TBD if this is actually spilling over into Bitcoin. Let's flip it fully back now to Gbtc. I appreciate you guys entertaining my my wild ramblings from time to time. Which of these GBT star charts would you like to go over first?
I mean, I don't know if we need to get hung up too much on GBTC. Rather, I guess just relating back to your point or Sam's point, about quarterly rebalancing. I would just say in terms of like the Bitcoin space, the reality is, and long term, like I think probably most people in this room listening, myself, Sam, a lot of people, most everybody on the Bitcoin Magazine team, probably everybody, the long term thesis is unchanged. Bitcoin is still is a superior monetary asset compared to everything else. That is unchanged, and I believe its valuation in 10 years from now is probably 2 orders of magnitude higher. Over the short term, we have this entire industry essentially imploding with leverage cascades. I don't think it's necessarily done, although we might be safe for the moment, for the time being. But it's all this bull market nonsense that propped up the price of Bitcoin, for like, and then pushed it higher than it would have gone otherwise, like GBTC, like all the leverage in the derivative markets, which has mostly been wiped out. The DeFi complex, that all hasn't been wiped out. All the yield harvesting strategies that wouldn't actually yield, just risk premium harvesting, that's getting wiped out. I do think now we're at the point where all these institutions that did buy Bitcoin, that would have bought Bitcoin, say that bought it in the summer at $30,000 in 2021, they're getting a tap on their shoulder, or not getting, have already gotten one that says, there's no way you're touching this. We're headed into a deep recession. We're cutting back all our volatility, all our risk, and you're gonna go buy something that is in a wild west industry. There's no regulation here. It's extremely volatile, and we're cutting risk. So the institutional flows, aren't here, and really any rally that we've had in Bitcoin or Ethereum, and I say Ethereum because it matters in terms of the exchange rate. And I'm, I've done quite well like shorting it. Just full disclaimer, I guess. Any rally that we've had since, for the last 2 months has just been short covering. It has had nothing to do with huge spot buying. I mean, Michael Saylor's throwing in spare change, $10 million. But besides him and maybe a few others, buying privately, there's not that huge institutional demand, and probably won't be until the air clears. We see the publicly traded miners starting to get pressured really, really hard. They all leverage their balance sheets and kind of had this golden 6 months post China miner ban where they were extremely profitable at profit margins in the 89%. That's all coming down, and so I think not to be a bear here, but I would be happily surprised if 20K was, or whatever, 17.5 was like the generational bottom. It just seems like there's a lot more catalysts for some rougher spot going forward, including potentially the worst recession many people have seen, in terms of whether it's worse than 08 or not, who knows, but in terms of just like the energy, the food shortages, and debt dynamics, it's certainly not a pretty picture.
I think you've been hanging out with Pete Rizzo a little too much, Dylan. We'll talk offline about that time. I'm not going to ask you the question that you have frankly baited me into asking you about correlation, but I'm not going to ask it. I am instead going to keep going down this Contagion Report, and we won't talk GBTC. We will talk now the futures perp market and just what you guys are seeing from there. Ultimately, and I want to touch on this because I don't think we have yet, all of this from your guys' finding and analysis just goes back to the idea that a lot of people got duped into the idea that yield was an actual thing. So I don't know if we want to start there, or you guys want to touch on what you guys are seeing in the future premium market first.
Yeah, we jokingly put in towards the end of the report, we put in a quote, and it said, your yield is not yield. And then it was a quote from Do Kwon, which wasn't actually a quote. And we crossed it out and said the authors of this piece, like where the quote originated from. It was kind of just a play on words of Do Kwon's, your size is not size. But the reality is just to repeat, none of the yield was actually sustainable yield. And it was all just layers and layers of leverage and speculative bet and arbitrades that were never going to be sustainable, especially as people piled in, right? So for instance, during the bull market, especially after Bitcoin broke 20K in December-ish, for about a span of 4 months, you had annualized yields or interest rates to long Bitcoin were like 20% to say 40, 50, 60%, whether you're looking at the perps market or like quarterlies, as well as the yield being market neutral. And so all these yield arm firms like Celsius and BlockFi could make it during those market conditions, but ultimately all that variable APR to long Bitcoin was never sustainable. So now, I mean, the GBT's done that annualized rate to long Bitcoin. Like you can look at perpetual funding rates or the contango, which was a big word in 2021, the price of futures above the spot market. All that's basically gone. All that arbitrage is flat. And you know, the derivative, the liquid derivative market, not the off balance sheet stuff like Voyager and Three Arrows Capital, but all of that has been wiped. And so, yeah, I guess I don't know if Sam has anything else to add, but I think at the bottom you're going to see, you know, basically the opposite of what you saw in the bull market, which is someone has their echo. I don't know whose that is, but yeah, there you go. I just think that, you know, what you saw in March of 2020 was all of these derivatives, the derivative complex was extremely bearish at the bottom and was actually paying these crazy variable rates to short Bitcoin. So I think that's what I'd probably see, or what I am expecting to see, you know, whenever we bottom out hard in the next, I don't know, 6 months or so.
Yeah, I would just add, I mean, we won't stay on GBTC too long because we talked about it a lot, but I mean, just from a bearish point of view, you know, in hindsight, look at it now and say, structurally, it's just a completely different market without GBTC buying and how impactful that was kind of in that bull market, that run up. And so from that, like 2020 to 2021 to when that kind of basically the discount goes in, the premium goes away. You know, they bought 394,000 Bitcoin added to the trust, which is close to about 80% of the new issued supply that came out there. So, you know, that whole bull market is just completely fueled with the arbitrage, the speculation, you know, some of the institutional demand too, and the investor demand coming in. But now we're just completely without that. And to Dylan's point earlier, like when people think about buying Bitcoin now, and let's say that they don't want to think about the self-custody route or the censorship resistance piece of it, or it's in a portfolio or an investment decision where they can't buy spot Bitcoin that way, that $13,000, $14,000 GBTC discount to get exposure also looks pretty promising if you're weighing the odds of what spot approval looks like. But I would just add to Dylan's point on, you know, these perps funding rates and the kind of futures cash and carry, the contango trade that was there. We've got a chart on that. I think might be shown on the screen. That's essentially like that these rates just get essentially decimated over time. You know, at the beginning of 2021, you have these arbitrage spreads where, especially in the cash and carry trade, you know, you could be making something of 15, 16% at the start of the year. And during like that peak bull market, kind of into March too, that was, you know, 40, 50, 60% at times. So, I mean, that's really the rates that people saw some of those arbitrage opportunities and piled in. And on the back of that too, that's what a lot of the lending yield shops were playing in too. I mean, that's why, I mean, we've seen consistently over like the last 2 years, these lending yield shops, their rates getting completely compressed over time because, you know, this arbitrage essentially arbitrage away. It wasn't necessarily sustainable for the market. It's kind of like the short opportunity that becomes efficient as time goes on. And so now when we look today, I mean, these are like basis points of what you could get. Obviously the trade is more appealing, kind of the contango trade where futures is getting out of whack with spot price during bull market, but you know, these markets are getting more efficient too and kind of arbed out in the same way. So, you know, a big part of this is, you know, the pressure in terms of like the contagion is like, as these rates get compressed, this arbitrage opportunity goes away, this, you know, quote unquote yields that was out there to support this, right? Loaning your Bitcoin to these shops. So that people could take on these strategies. As that gets pushed away and falls off, these shops want to maintain yields. They want to maintain the retail user growth. They've got to go out and search for other opportunities and kind of yield strategies, if you will, risk strategies. And that's kind of, at the same time, this is where the Anchor, protocol, the UST, the Luna project comes in and offering 20%. So kind of in the back of like all this getting compressed, you have this, quote unquote 20% yield that's coming into the market that looks more appealing. And obviously it depends on the shop. Like someone like Celsius, we can see put a lot of capital into Anchor, so did 3 Years Capital, and it's not as clear as maybe some of the shops like BlockFi and others on essentially what they were doing. I think that's just a transparency issue overall, but essentially as that rise, the shops get pushed a little bit more out of the risk curve to serve their users and serve those interests.
Okay, I know, and I need to unmute on Twitter. I know how much you hate these line of questionings, but entertain me for a moment and I'll tee it up so it's a lot easier to answer. Rather than giving like a direct yes or no, let's play with probabilities on both sides of the coin here. GBTC is obviously attempting to, and has for a while now been attempting to change to a full-blown spot ETF. What effect do you think that would have in the short term on Bitcoin price, percentage wise, positive, negative? Like what are your expectations at if that were to go through?
I mean, it's not going to happen. So at least not this next
Okay,
approval.
Gary Gensler
next,
died. Someone else that's pro Bitcoin is now in charge of making that decision.
I know GBTC would bump. I don't know how that would work because there would be a lot of people that would buy GBTC just to dump Bitcoin. So honestly, maybe Bitcoin pumps in the interim, but it would probably net neutral be. I think it wouldn't make a huge market impact. There's not, maybe during the next bull market, but there's not all these institutions rushing to allocate to Bitcoin. Maybe they dabble in it, but the real trade would be buying some GBTC at a 30% discount, and then your $70 turns into $100, and you get 40% gain on Bitcoin. That's the trade. I'm not sure about Bitcoin itself, and I'm not gonna really pretend to know. But yeah, that's what I would say. I mean, if you want to think of just hopping back a little bit, people like to talk about Michael Saylor and his 130,000 Bitcoin. Like Grayscale bought 3x the amount that Saylor did, and they stopped buying in February, February 2020. So 3 Michael Saylors is quite significant. Just for some context.
Yeah, just to add to that, like when you look back now too, I mean, there's a lot of whether you're looking at price signals or on-chain signals or returns or like the transaction fees on the network, that March kind of top right before that too. A lot of people can look back and say, okay, like the November looks like the top Bitcoin price, but really the level of demand looks like it subsided and activity on the network a lot during that March time right before that GBTC kind of goes into discount right into February, right before that. So another reason is like just iterate how big this was in terms of the market size here. I guess I would just add to Dylan's point. Yeah, I think speculative questions like that are fun, but they're just so hard to answer in that way that it just seems like there would be another arbitrage trade that would just be had for GBTC, but it doesn't necessarily change more of the macro demand kind of landscape for risk assets at the moment, and where people are in terms of thinking of the positioning in terms of their overall investment. So it's hard to see that you'd see maybe more of an explosion in spot demand, even if the GBTC kind of was to get turned into a spot ETF or somehow go back to neutral.
All right, you've already asked me to stop bringing up GBTC, so I promise no more questions on that. I want to pop over to slide number 7, where you guys have taken both the total Bitcoin market cap as well as the broader crypto market caps and kind of shown the contraction that both of these markets are seeing. I want to maybe understand a little bit more of what are your guys' expectations with the broader crypto market as well as Bitcoin. We're seeing a lot of overlaps. We're seeing casualties in the Bitcoin price as the result of decisions made in broader crypto. What are you guys paying attention for? What are some signs you're looking at the chart at the top in particular?
It's all garbage. I mean, that's my opinion. But like if we look at the second biggest quote unquote cryptocurrency, Ethereum, it was ICOs. It was less elaborate Ponzi's last cycle, and dApps, which was just a money grab. This cycle, it's just basically liquidity pools, swapping assets to trade and lever up, and DeFi protocols to trade and lever up. Certainly, it's cool that you can remove a centralized institution to get leverage, but I personally don't think Ethereum, despite being the most quasi decentralized of the smart contract protocols, I think it has a huge embedded monetary premium. I think I'm super bearish ETH BTC at 0.055 or whatever it is. It's ridiculous. It has 50% market cap of Bitcoin over the long term, I think. And so, yeah, I mean, a lot of the crypto, like I hate Bitcoin dominance as a metric. I mean, I guess you can look at it for fun. Sometimes I do as well. But there is no liquidity in besides Ethereum has some liquidity, but besides that, the rest of it has no real buy or sell side liquidity. And that's why these, they've already bled out 90%, 95%. And so, the total crypto market cap of like $1 trillion is actually a lot less. If you look at just what happened in the wake of Three Arrows Capital going insolvent, and all of that collateral being liquidated, I mean, they had however much they had, probably a few $1 billion of sell orders, and the total crypto market cap dropped by $500 billion, right? So to think that there's, or I don't know, that was top of my head, like a napkin math, but to think that like there's actually the total crypto market cap was $3 trillion ever in real liquidity is nonsense. And obviously, it's probably same with Bitcoin, but to a lesser extent, because it actually has some real buy side liquidity and sell side liquidity. And it's actually it's just a monetary asset. It's not a Rube Goldberg machine where you can spin up elaborate scams and Ponzi schemes. And so maybe that's a little bit pessimistic, and I certainly don't discourage anyone from building, but from what the market's shown over the last 5 years, most all cryptos have been just kind of elaborate insider pump and dumps and rug pulls. And so, yeah, I mean, I'm quite bearish on the crypto space as a whole, and especially post kind of Luna UST collapse. I think what that showed was a lot of the quote unquote smartest people in the room, the experts, the smart investors, really had no idea what they were doing. Locked vested Luna, like Barrows bought $500 million of Luna that was locked for years, 3 days before the collapse, right? So like, and these are supposed smartest guys in the room. Novograt's got a Luna tattoo, and he bragged about exiting before the collapse. Like, weird brag, bro. So maybe that's a little bit harsh, but like, this it's a lot of vaporware, and yeah, and Bitcoin, I think, there will be another cycle of vaults. There will be another cycle of kind of nonsense on a blockchain getting bid to extreme levels. But yeah, I mean, I think Bitcoin's real innovation here, proof of work, and immutable property rights, and then the rest of it is kind of latching on and riding the liquidity tide. And so, yeah, that's just my 2 cents. I don't even know what your original question was, but a little bit of a rant there.
Tell me how much you don't like the broader crypto market, I think would have been a better question.
No, like I've made out great shorting Ethereum recently. I mean, my entire net worth is hedged with Ethereum shorts, so that's awesome. It's useful for something. But
full disclosure,
yeah,
this is not financial advice. Do your own due diligence.
Yeah, but yeah, I guess that's all I'll say on that topic.
Do you want to keep going down the dunking on ETH path? Because I thought that your little flow chart you guys created for the ETH staked ETH sort of cycle that I believe it was Three Arrows was using and capitalizing on was excellent. I don't know if you guys want to touch on anything else before we go to that. Chris, I believe that's slide 11.
Yeah, that's a Bloomberg chart. But I mean, this was like the another arbitrage in DeFi. It's just like it's tech debt layered on top of real debt layered on top of illiquidity risk. It's just, I mean, they deserve to blow up. I mean, these guys the Three Arrows Capital apologists are just it's unbelievable in my opinion. These guys were these guys are taking on irresponsible risk, and essentially the more and more that comes out about from insiders, from people with counterparty exposure to these guys, it wasn't irresponsible leverage, it was fraud. So like saying these guys were great, they were good for the industry, they were champions of it, like nope, fraud, they deserve no respect. And so lever up ETH with staked ETH, put staked ETH in the DeFi protocol, borrow against it, get ETH, and then stake that ETH, and like what a Rube Goldberg machine of nonsense and illiquidity risk, and they blew up. And so that's the end of them. Staked ETH, hopefully it works out, and proof of stake's great. But from what Ethereum lead developers are saying, it's already too complex for 99.99% percent of people on the planet to understand. And I'm personally thinking that the tech debt on Ethereum eventually catches up with itself. I mean, most people would rather use something that's faster and less centralized, or less decentralized, right? Like people on using Ethereum don't actually care about decentralization. And that's why you have people using Solana and whatever next smart contract platform comes out with some ridiculous monetary premium. So I think Ethereum moving to proof of stake is actually a pretty big flaw or error, even though they committed to it back in like 2015. I think it would probably be much more sustainable if it was a proof of work network, layer one. But that's just my opinion, and I don't really know anything, so not financial advice, I guess.
Yeah, I would just add to, in terms of what this meant for like Three Arrows Capital too, is like when that basically Luna UST blows up and they have this huge position there. They also have huge positions in, think about GBTC, they own somewhere of like 5%, 6% of shares, all of those going to like pretty strong discount. So, I mean, if you're ever going to redeem any of those or make any money, it's like a longer duration play. So you have huge kind of duration risk here at a time when they needed essentially pull out capital from whatever unsecured lending kind of stuff that they had lost or yield that they couldn't into. So, going into staked ETH and not exactly what their position size here, there might be some better kind of like on-chain forensics to show how big this was, but essentially trying to keep the staked ETH position to then borrow against that, to then pull more yield out of kind of the Aave pools and liquidity pools. But then also having this huge position of staked ETH that's kind of turning away from its peg for a lot of reasons. One of those being that, staked ETH being locked up Ethereum essentially till the merge happens. So there's a risk as that peg kind of widens that there's a bigger market risk of the merge actually happening in there. So as that goes down, their position's going down, and then you're really locked in these like two longer term duration assets when you have an incredible amount of kind of unsecured liabilities and yield to pay against. And it's been said with a lot of institutions with Three Arrow Capital as well, is that people had accounts with them, whether to do sorts of better trading with lower fees and having money parked there and essentially making a yield on top of that. So it really just became a play at the end here over the last month through May. And I mean, it even surfaced in June with the block that, they were looking to pitch investors on another style of GBTC arbitrage play to try to get some of that capital back. So kind of once this Luna UST blow up really happened and they didn't have the risk management size to deal with it. A lot of these duration positions they were in just kind of perpetuated that even worse until it kind of its final blow up. So
Correct me if I'm wrong drawing this conclusion. It feels, especially when you involve this sort of yield product offering or whatever we want to call it, that type of product, that type of idea and mentality is rooted back in the fiat system that Bitcoin is supposed to break away from. We were having a conversation earlier where this idea of how do we fully flush out all of these bad ideas so we never have to see them again. But it feels like they're just getting reintroduced in these crypto markets. I'm genuinely curious what either of you two think a viable solution would be. And I don't mean to put you guys on the spot and ask you, hey, solve the global financial issues in both the fiat system as well as the broader crypto system. But in short, that is what I just asked you.
Yeah, I mean, if you want yield at this point, like if you want, say, stablecoin yield, okay, don't go on Aave, don't go on Compound, don't give your money to Pharaoh's Capital. Go buy short-term treasury bills and get your 3%. Stop being a moron. Sorry for sorry for being a little blunt, but don't take on any duration because if yields rise higher, anybody that was long bond investor has gotten absolutely smoked for a supposed safe investment. But if you want yield, it's not 2020 anymore. Treasuries aren't giving you 50 bips; they're giving you 300 bips. Go park your money in a short-term treasury bill ETF and get your 3%. And basically, that's yield farming dollars, right? If you want yield on your Bitcoin, just send your Bitcoin to me because you're gonna lose it all. I guess you can open up a Lightning node with a million Sats or 10 one Bitcoin and get routing fees and make $12. That also works. But in terms of sustainable yield farming with size on your Bitcoin, don't do it. And the DeFi protocol, the dollar denominated yields in this space, every single leveraged or lending desk and all of these funds that were kicking off these strategies have either all blown up or the arbs are gone. And so none of it's sustainable. So again, I mean, I don't know. In terms of the yield farming stuff, it's never was sustainable and it's done. So go buy I mean, I would never say go buy treasuries, but if you're holding cash in a brokerage account, buy some short-term treasuries and get 3% on your money. I'm like, that's the government's not going to default. That's part of the reason why I own Bitcoin, is because the U.S. government will never nominally default on their debt. They'll just get the Fed to monetize more and pay you back. So, yeah. That's my thoughts.
Not financial advice. Do your own due diligence. But also, I just bought a bunch of treasury bonds now because I'm smooth brained like that. I thought
not bonds. Don't buy bonds if you want. They're bonds or bills. The bonds have duration risk, which is why I wouldn't buy treasury bonds. But the 1 to 3 month bills, right? That's just it's cash with a yield, and that's an important distinction. So yeah, I know you're joking, but still.
Fully joking. I need to fully re-emphasize, none of this is financial advice. If you're taking advice from a high school senior because you listen to him on Twitter, you got some soul searching to do, my friend. We haven't really talked Celsius here. I know last week we spent a lot more time on it. Can you guys talk just a little bit? Because I thought the timeline you guys introduced at the very end of the report was fascinating, just to see sort of how each of these dominoes one by one fell and led to the next domino. What was the catalyst that caused Celsius to start to have to unwind? And as a result, what has been affected by this Celsius unwind? And I believe we've already discussed literally both of these, but I want to just interject what was happening in between.
Yeah, maybe I'll just, kick it off to, essentially how I would see Celsius is, a lot of customers thought it was more of a safe place, this savings, essentially market that they were in. But out of all these shops, Celsius was furthest along this curve. And it was much more of these really risky kind of speculative hedge fund strategies that they were deploying a lot of capital in. Just from a timeline perspective, in early April, you have basically this peak in DeFi kind of market cap falls, 73-75% since then. A few days later, you kind of have Luna market cap start to peak out around 41 billion. And some of that demand is really starting to cool off and fall away, but that that UST, that 20% yield is still there. And so, I'm not sure in terms of the back end. I don't know, Dylan, you got insights on that of like why, Celsius kind of made these broader moves, whether it's these other arbitrage speculative trades blowing up or kind of this lack of liquidity drying up to like go out and get some of these yields, or they're starting to become a little bit more insolvent or not being able to hit on some of those liabilities they needed. But like basically that next month in early May, it looks like they deposit over $275 million into the Anchor protocol, and that's that 20% kind of UST protocol that's happening. And it's just 3 days later where that kind of Luna UST really starts to depeg. And 4 days later, where you start to see the Anchor protocol deposits really start to turn over. So they collapse. There's about like $14 billion in this Anchor protocol that's yielding this 20% for UST. It collapsed to 1 billion basically over the course of a week. And essentially, they're pushing in a ton of money into this protocol. I don't know what they were able to necessarily take out as this was turning over, as this essentially exploded. And I know there's some speculation in like the initial come down that, basically people were seeing this and saying, okay, how can we, cap, kind of profit off of going like pretty big short on this and watching this unwind. But, at the end of the day, Celsius just totally caught in this entire unwind on the Anchor protocol, which, ends up being like a pretty large portion of customer liabilities. And then you have a multitude of things that happen kind of from there. And then you kind of get into, later into June where CEO Alex Mashinsky is starting to say that there's no problems with withdrawing from Celsius. And then, basically a day after that, Celsius has complete withdrawals, swaps, transfers, can freeze the assets.
Yeah, I mean, once it was that you could see on chain. I don't follow like ETH on chain movements, but I follow people on Twitter that do. And once you saw that Celsius was deep in Anchor, that's when I was basically saying, okay, they're screwed, and started to. I have a thread pinned atop of my page, kind of documenting some of my thoughts on there, and I've gotten a lot of DMs and stuff that's helped people get off and alert people. Certainly wasn't trying to start a run or anything else. But I think the concept of fractional reserve banking, rehypothecation on a hard money standard, especially in an industry with no lender of last resort, was always doomed to fail. And so it's unfortunate. There's a lot of people that have their funds on there. I really hope you can redeem them or get them back. I'm not. I have no hope or not much hope for that outcome. Given just terms and conditions. I mean, you were always an unsecured creditor, and it was never yield. It was never about unbanking yourself. It was kind of layers of leverage and obfuscated risk. And so, so that the Celsius trade also, they were big into staked ETH, and so you started to see that depeg, and there's problems. So yeah, I mean, I've talked about Celsius in length in previous videos, and we've written a lot about it. If you want to just go to bitcoinmagazinepro.com, we have a lot of like free articles on detailing all the situation in pretty good detail. But yeah, I don't know if I have too much left to add there.
I would only add too, I mean, just from like a retail user perspective, it's, from a marketing, what Celsius done, kind of like not being transparent about what they're offering is obviously not the type of business that you want to be invested in or part of or deploying your deposits at. But from, the user standpoint, I mean, have some sympathy for people that are going to lose a tremendous amount of wealth in those two, basically because of a lack of transparency, black box around what risk was actually being taken. I think what's interesting now is, basically these things pretty much headed for bankruptcy, having a distressed buyer come in and buy distressed assets here. But I mean, there was just an article released the other day of just that still people within that have funds on there. There's kind of this incentive now to even put more money into Celsius, which is a weird kind of fucked up incentive, because that might deploy enough capital where they don't have to go the bankruptcy route. So I think it's a obviously destructive, sad, speculative greed kind of all across the board in one. And Celsius just becomes a face for a number of other shops here that are either at risk of insolvency or have to halt withdrawals, or go find a way to come to terms with new debt structures at higher rates to get out of this. We've listed probably at least 10 or 15 other shops that we know of that are all having these types of problems. Probably not to the extent of Celsius, and that's just the ones that we've become public. So, all of this in terms of like Contagion, it's almost like every day now we're getting new news out on kind of a new development with one of these shops, or a new shop that's coming out and saying, hey, we're at risk. I know Sam Bankman-Fried just came out yesterday and said he knows of other exchanges that are out there that are still insolvent, that haven't come to the table, and we're watching some of this BlockFi stuff play out in real time as well. So I think we're far from over from seeing kind of leftover damage here.
Would it be fair to assume that as more of these come to light, this will have a negative effect on the short-term price of Bitcoin?
Yeah, I don't know how much leverage there still is out there. We can see, and what we focus on is the transparent data, so we can see the amount of open interest, we can see funding rates, and what longs or shorts are kind of pushing the price one way or another. I think it's important to understand there's a spot market price, BTC USD. You swap your dollars for for sats on Swan Bitcoin or Coinbase or Strike or whatever else. And then there's a derivative complex that can in the short to medium term really push the price of Bitcoin and all of this one way or another. What I think really I would say is probably the biggest flaw in some of the analysis going into 2022 that we put out is just not understanding how much off balance sheet leverage there was, unsecured credit, never mind over collateralized. But that's why we're in this kind of crisis, right? That's why Bitcoin's at 20K. You have Voyager lending Three Arrows Capital 15,000 Bitcoin and $350 million completely unsecured, which is unbelievable, being honest. And so that's why we're seeing this balance sheet contagion. And so how much of that is left out there? Just kind of talking some funds, talking to some lending desks. I think a lot of those loans, whether it's unsecured or callable loans or whatever, a lot of that got pulled, because all these desks were trying to see if there's any more dead bodies. So a lot of that open debt was pulled, and you kind of saw that forced liquidation play out. Whether there's more collateralized debt or liquidation levels below where we are today is yet to be seen. But I think really the bottom, maybe if this is the bottom, it's coming after all of this debt's liquidated. But Bitcoin bottomed in 2020, and it bottoms because all of this collateralized debt, mark-to-market debt is wiped out, and the forced selling, the brunt of that's over. And so we'll see if we're there today. But I certainly know that there's a lot of minor debt out there that because this is the first cycle where you didn't see miners selling on the way up. You saw that HODL strategy where you could get debt financing for your operation. I think that's probably the next, or the biggest catalyst that I see for further downside, is that you see these operations really start to get squeezed.
I might be the Matrix. I'm sorry. Word, Sam, Dylan, we're at the end of our hour. Look, I say it to you guys every week. BM Pro is truly my favorite newsletter that I read. This detailed analysis of just the contagion that's been going on around the entire market is a necessary and required reading for everyone who is involved or paying attention to the market in general. I'm not saying you need to use this information to trade off of, but to just understand, I think, market sentiment is super, super helpful. And I love the little bit at the end where you guys say to be continued, because it does not seem like this is over. In fact, we are far from seeing the end of this. I'm deep in the matrix, so I have to stop talking.
Cool. Well, thanks for everyone that tuned in. And we'll catch you on Twitter. We'll catch you in Substack if you subscribe. We have free and paid tiers. So give it a look if you haven't already. And we'll catch you here next week.